Hey guys, in this video, I'm going to walk you through the one core strategy that if I could trade nothing else, it would be this one. And why? Because this strategy has generated enough money on a consistent monthly basis to be able to replace my wife's income and allow her to retire, which I'm super excited for. Not only have I used the strategy, I've helped over 600 other option sellers actually put this into practice and use it to make consistent monthly income. So what are you going to learn from this video? Let me shrink my face so that we can get into the good stuff. You will learn first and foremost, what are options? So you're going to learn a quick summary. What is option selling so that we can dive into the strategy, which is an option selling strategy. So you're going to learn my one core strategy for reliable monthly income. And that's going to involve talking about how to trade it on the chart, how to enter it in the broker so that by the time you get done with this video, you can actually implement it and use it. I'll show you how to manage risk because that's the most important the most important part of any strategy. Then I'll show you a case study of how I personally use this strategy to make over $5,000 a month. Again, just for proof here, I'll refresh my screen. Again, the market is down roughly 26 points as we're talking, but I'm still making over $600 from using this exact strategy. That's a 7% return on my money in a matter of 15 days, which is awesome. It totally beats interest. Okay, so let's dive into it. So the first step we're going to cover is what are options. And so there's a couple things to know about options. And I'm going to simplify this in a very simple way. Options are betting on an outcome of a stock or another asset. So if you've never, or I should say, if you've done sports betting before, it's the same thing where you're betting, hey, I bet this football player can run so many yards. Or, hey, I bet this player will hit a home run. You're just betting on what a stock will do. Hey, I bet the stock will go higher. I bet the stock will go lower. And how this manifests is there's two types of options. There's call options and put options. When you buy a call option, you're betting that the stock goes higher. So if the stock goes higher, you make money. When you buy a put option plus for buy, you make money when the stock goes down. So if you buy a call, you're betting the stock will go higher and you make money when it does that. If you're buying a put, you make money as the stock goes down. Now you can also sell a call. If you sell a call, it does the opposite. If you sell a call, you make money when the market goes down. And when you sell a put, you make money when the market goes up. Now, all the money is made in option selling because when you sell an option, you become the insurance company. You collect premiums and you control how much risk you take. So basically, people pay you to get access to an options contract. And so that's why you're receiving money. And so that's where option selling comes into play. So how exactly does option selling help us do this? These are just numbers here. What does this actually mean? Here's what a selling put actually looks like. If the market is trending higher like this, let me move this out of the way, and the market is trending higher, then what we will see is that we can sell a put above a certain level. So I say, hey, I bet that the stock will stay above this level. And if it does, I make money. That means if the stock goes higher, I make money. If the stock goes sideways, I make money. And if the stock goes down, I make money as long as it stays above my level. I only lose when it goes below my level. Now, this is so much better than buying an option because when we buy an option, we only make money if it goes in our direction. So let's say we bought a put here. I would only make money if it went down. So if it went down, I would make money. If it went up, I would lose. Versus this one, it can go up, down, sideways, whatever, and I still make money because as an option seller, I have a higher win rate and I can let it do whatever it wants as long as it stays above the level that I'm betting on. And so the same thing happens for a call. Let's say we have a stock that's trending down. And so a call, I just bet on a level up here. As long as the stock stays below this level, I make money. So this is a put selling example, and this is a call selling example. And so again, you can see how consistent and how amazing this is because you don't need to be right on the direction. You just need to be right that it stays away from a certain level. And you can pick levels way far away from the stock so that you have a huge win rate. So that kind of leads into the next question. What is this one core strategy and how does it combine these two things? It is a strangle strategy, okay? Here is the strategy. I'll walk through it here in a second, but I do want you to have some proof. Here's the back test of it. I'll walk through all the rules in a second, but you can see how consistent and reliable it is. 98% win rate here. You win about $800 per trade. You lose about $7,000. I'll be showing you how to massively reduce that risk because my losses are never this big. And so again, I'll show you how to reduce risk later in the video, but a 98% win rate. And when we're doing well, we can really trend and make good money. And so I'm going to show you how to do this and take advantage of it. So a strangle strategy looks like this. Let's say the stock is trending up. You're using both a put selling and a call selling, which means you just pick two levels as you think the stock will stay between. If the stock stays below this level and above this level, you make money. This is how a strangle strategy works. That means they can go up and you make money. It can go sideways and you make money. It can go down and you make money. You only lose money when it breaks one of your levels, whether it's the upside or the downside. Now, the way that I structure these, I give myself so much upside room and downside room so that I almost never hit it. And that's why I have a 98% win rate on these trades. So that's a strangle strategy where we're basically using both as selling a call and selling a put. Now, here's how the trade is actually structured. I'm going to show you how it's structured, then we'll put it into a broker. What we do here is we're structuring this trade based on this outcome. We're trading it on in the S&P 500. Why? Because the S&P 500 tracks all 500 stocks in the market, or say 505 of the best stocks. And so it's very diversified in and of itself. So it's already a super safe stock. We don't want something moving super fast. We want a bit of a slower mover for this strategy. And so we're going to take advantage of that by using SPY, SPX, and then my favorite, futures. If you have access to futures options, doing this on ES will provide a ton of leverage, which you'll see in a second. So these are the assets that we traded on. Next, what expirations do we pick? For the expirations, we're going to pick 90 to 120 DTE. And you may be wondering, what does this mean? This means that we're going 90 or about 3 months to 4 months out into the future. Every single option, you're basically betting on a certain price point, but also a certain time. And I'm saying, hey, I don't think the stock will get below here or above here by this date. And so I'll explain more why those dates are so long when we get to the risk section, but this is exactly how I do it. And then from there, what I do is I need to pick these levels. And so I pick the bottom level by skewing it. And what do I mean by this? What I do is I give myself more room to the upside and less room to the downside. Why would I do this? Because overall, 9 times out of 10, the market tends to drift higher. It tends to trend up. And so if it's trending up, I don't want it to keep hitting my upper level. So instead, I'm going to give myself more upside room and less downside room. So this is how I do this. For the bottom side, I pick a 10 delta put. And then for the upside, I do a 5 delta call, which gives me more room to the upside. These are how I pick it. Now, how do I manage the trade for take profit and stop loss to reduce risk? I do a 25% take profit. So this is my 25% take profit. So once I have a 25% return, I'll close the trade. And then I also do a 300% stop loss. And then again, there's other things I do to mitigate losses so that I almost never hit this level, but we'll talk more about that here in the risk management section. So this is the strategy. If you're taking notes, this is what you want to know. Now, how do we actually plug this into a broker so that we can do it? If I come over here to Tasty Trade, I click on trade, I click on symbol. Again, I left ES the best, but I want to show you the difference between ES and SPY. So we'll start off with SPY here. So again, we're going to look for the contracts that have a date around 90 to 120 DTE. This one here shows 91, so I'll stick with that, April 30th. On the right side is my put contracts. So I want to make sure that it shows me the delta. And so I'm going to scroll to a 10 delta, which is going to be minus 0.10. That's going to be my 10 delta. So I see right here, this is a 10 delta. I'm going to sell this contract. Now the left side is calls. I'm going to do the same thing, except I'm going to do the 5 delta. So you see here, I'm looking for 5. You can see here 6 and 4. I'm going to pick 4 because I'd rather go further away than closer. So this is what my strangle contract looks like. You can see here a $300, almost $400 profit that I'm going to see. And then again, I have to put about $6,000 to make this money, which is great. If we look at this actually from a number perspective though, you can see here I'll make about $400, but I'm only taking profit at 25%. So that means I'm only going to make about $100 return on this trade. So let's calculate how much money I'm making based on how much money I'm putting up, which in this case is $6,000. So $100 over 6,000, I get to make a 1.7% return on my money in about 17 days. On average, it takes about 2 weeks to close this trade. And so I'll make about a 1.7% return, which is still so much better than putting it in a bank for interest. And it's super stable with a 98% win rate. Again, we'll talk about managing more risk later, but this is a really great strategy. Now, this is still a great strategy, but if we do it with an asset that gives us better leverage like ES, then we can do something really great. So remember, SPY gives about a 1.7% return. If we set up the same trade on ES, which is futures options, again, we're going to do the same thing in 91 expiration. We're going to pick the same levels. So we're going to pick 10 delta put and then a 5 delta call. And just like this, you can see we're putting up about the same money. It takes about $6,400 to put on this trade, but we get to make $2,000. Now, again, that's not 2,000 because we're taking profit at 25%. That's a $500 return per trade. You can see here, we're making 500, putting up about 6,500. That means I'm making a 7.7% return on my money every 2 weeks. And so that's why this strategy is amazing and why I run it on futures, because not only do futures gives me a tax advantage, and not only are they super liquid, but I get to make a 7% return on my money. So now you may be saying, Austin, that's great. You showed me the strategy, show me how to implement it, show me how to manage risk. And that is a great question, because we need to manage risk, especially if we're doing futures. So there are a couple ways to manage risk. Number one, we need to control our buying power usage. Okay. So BP usage. This means how much money are we putting into trades? Okay. It's ideally best practice to do no more than 30% of your account into trades. So this means that if you have a $100,000 account, you should have no more than $30,000 actively in your trades. And if you're doing this, this can help tell you how many trades you should be in at one time as well. So let's say you have a $100,000 account, just for easy math. That means you should have no more than $30,000 in trades at any one time. And so if we do 30,000 and it takes about $6,000 per trade, we now know that we can have 5 trades running at a time. So this helps us size our positioning correctly. So 5 trades for this account. And so since it takes about 2 weeks for these trades to close, that means I can be putting on about 2 to 3 trades per week is how I would set up the structure for this. Again, if you're starting off, start small and slowly scale up. But the max point at which this account can get to is probably two to 3 trades per week, which again, if you're doing it on ES, is insane, because you're making about $500 per trade. So it's going to be about $1,000 to $1,500 every single week based on the trades that you're turning on, which is great. So buying power usage and restricting this is the first way to reduce risk. Number 2, we can also reduce risk by understanding VIX, which is the volatility index. Okay. As an option seller, when VIX is higher, we have less risk. When VIX is lower, we have more risk. So what do we do here? When risk is higher, what we do is we can enter in more of our position. So for instance, we're using this 30% as our max position sizing. If VIX is high, we can use our whole 30%. If VIX is lower, we can use maybe half of that, maybe 15%. Okay. Now, why is this? Because when volatility is low as an option seller, that means there's a higher chance of VIX going higher. If VIX goes higher, we lose money as option sellers. So we still want to make money. We still want to be a part of putting on trades and generating a return, but we want to make sure we're sizing our risk based on the risk in the market. So this tends to be how I look at it, but do your own research. If VIX is below 15, this is a higher risk point. So from here, I put in about 15% of my account, right? Roughly. And VIX is greater than 15, meaning that the risk is lower, then I go closer to 30% of my account. So that's how I trade the volatility. And this helps me reduce the volatility risk and size my account proportionally based on the risk in the market. Another way to reduce volatility risk is not only to size correctly, but to use longer DTEs. So again, this is why we use 90 to 120 DTE trades, because the further out in time we go, the more time we have to be right on a trade, which means that our risk is lower. And so volatility impacts longer DTEs less. And so that's why we do a 90 to 120 days out trade. So first one is the buying power usage, then VIX, and those are some ways to fix it. And then third is market risk. So as you saw there, if the market crashes, again, volatility is going to spike and we're going to lose a lot of money. So the first thing we do is that's why we have stop losses. So that's why we have our 300% stop loss. It is a larger loss, yes, but this is a great way to just immediately cut losses quickly. Another way to do it is to use indicators so that you know when a crash is coming and you can stay out of the market during those times. And so if you want to see a great example of that, if you go to TradingView or basically any charting platform and look at what it's doing, you can see Chris Spy is actually having a pretty nice red day. Again, I think it's the FOMC days right now. But we go to a daily chart again to see the long-term view of this. Well, I got so many. What you can look at is you can go to indicators and go to something like a Bollinger Band or whatever it is you want to use. But a Bollinger Band shows a good little example here. And whenever the market breaks out of the upper ranges, then you know that, hey, a pullback is likely, right? The Bollinger Band shows when the market is overextended. And so this is one example of using using an indicator of when the market breaks above it to scale down your trades or get out of it, so that when the market pulls back, you're not involved in that and you have less crash risk. Like for instance, if we look back here when the market crashed in 2020, bumping into this zone and then crashing down, we could have lost thousands. Yes, we're missing out on potential for profit, but we're also saving ourselves from losses. So finding a good indicator to warn you about crashes before they happen is another great way to reduce risk. And if you do these three things, these will help you cut down your risk dramatically so that you have a more stable, more consistent income in retirement or whatever you're aiming for this strategy. Now, we've covered everything that I wanted to cover here for the strategy, how to trade it, what it looks like in the broker, how to manage risk. Now, how do I personally use it to make $5,000 per month? It's a great question. And so again, I told you how I structure this trade and how I use buying power usage, and that's 100% true. So what I do is I have a $200,000 account here. And again, no more than 30% of my account in trades. So that means I can have up to $60,000 allocated to trades. And then again, I change the allocation based on risk, based on VIX. If VIX is lower, I'll use 30K. If VIX is higher, I'll use 60K. And that's how I use my trades to change based on my allocation. And then I trade it based on the number of trades per week based on what I can allow. So for instance, about $6,000 per trade. So when VIX is higher, I can do up to 10 trades every 2 weeks. So divide that by 2, I can do about 5 trades a week. And then this one was about 5, so I can do about 2 to 3 trades a week. And so that's how I know what trades to put on. But not only that, not only have I been able to use this to generate money, but one of the headaches of options and trading in general is the emotions, right? We have FOMO. We don't know if we should get in or out or the right times. And because of all that, it can lead to poor decisions. It can lead to us exiting at the wrong times. It can lead to our stop losses not working correctly. And so that's why I use automation to set myself up with this. And again, there's a lot of tools, but my favorite one is the options auto trader. And again, you can see here my account that I showed you on Tasty Trade. Here is my strangle trade. Again, you can see all the trade details here. Like I said, each one of these trades makes me about $500. You can see reward $580, $544, $488, $541. This trade that closed made me $478. As you can see here, each one of these ES strangle trades are making me about $500. I'm putting on it on twice a week, and that's how I'm running it. But now, how does this automation work if you're curious? You connect your broker, you create rules in this software, and then this software will follow your rules to execute your trades. So it's super simple now that we have all the rules. Again, I listed out all the rules for this strategy right here. We just take these and we plug this in and it will create a strangle bot based on these rules. So let's do that. We're going to click on create an auto trader, which is basically like creating a bot. I'm going to tell it what strategy I want to do, which in this instance, I'm going to sell a strangle. Then what symbol, I like doing it on ES, but you can pick anything you want. Like we mentioned, my expiration dates are further out. So I like 120 to 90 days. 120 is my preference. Like I mentioned, we're going to sell a 10 delta put. So put delta 10, sell 1, right? And then call, we're going to do a 5 delta so that I have more upside room. So just like that, I plug in the rules and it'll find that trade for me. Next, I define how often I'll enter the trade. And again, this is mentioned based on buying power, how much I have, how many trades I can put on. So for me, I do multiple times a week. I do it on Tuesday and Thursday to spread out the trade. So I do it twice a week. But again, that's going to depend on your account size. From there, I do how I want the trade to be managed. So maybe a 25% take profit, which is what I do, 300% stop loss. And now this will know exactly how to manage my trades once they're open. And then from here, I tell it how much money I want it to use. So like I mentioned, I like to do 30% of my accounts is about $200,000 accounts. So I do about $60,000 here. And now, like I mentioned, we need to manage risk, and we can do this by just enabling some buttons. So you can see here, if I enable this button, this will automatically size my positioning based on where VIX is. If VIX is higher, I'll use the whole 60,000. If VIX is lower, I'll use 30,000, and it'll size it for me based on where VIX is. And that's awesome. So now I can almost basically eliminate the volatility risk just by using one setting. I also have a market crash thing here, which is my math indicator that I built in 2018 that has been used to predict a lot of crashes. And so if a crash is coming up, you can actually use it to get out of your trades and get out of the market sooner. So just like that, I've helped eliminate market crash risk just by enabling some settings. So just like that, I have a strangles bot built around this amazing thing, and this is how I've done it. This is how I've generated the monthly income. I remove the emotions, I remove the time it takes looking at a screen, and I've automated a very consistent and very reliable strategy while also removing a ton of risk. And so this is how I was able to replace my wife's income, do so on a consistent basis without my need to be stuck to the screen, so that we can actually go travel. And so that's what I'm super excited about. If you learned something from this video, smash that subscribe button, and I'll see you in the next one. If you want to start your trial to the Options Auto Trader, click the first link down below.